Okay, so picture this. Your company's single most profitable partnership, the absolute core of your business, just vanishes. Poof, gone. Well, that's exactly what happened to the fashion giant G3 Apparel Group. So today, let's dive into how they're trying to pull off what is essentially a billion-dollar comeback.
And it all really starts with this number, $1.5 billion. At its absolute peak, that's how much their single most important business relationship was worth, every single year.
So what was this partnership? Well, for years, G3 held these super lucrative licenses to make and sell clothes for two of the biggest names out there, Calvin Klein and Tommy Hilfiger. This wasn't just part of their company, it was the engine, a massive, reliable river of cash flowing in. And then, poof. In a move that really sent shockwaves through the industry, the parent company, PVH, decided to just end it. They wanted to take all that business in-house. And just like that, a huge chunk of G3's identity and its sales was about to disappear.
And that really sets up the central problem here, right? How on earth does a company survive, let alone thrive, after losing a part of its business that brings in over $1 billion a year? That's a huge hole to fill.
So just for some context, who exactly is G3? Well, they're a massive player in the fashion world, a real powerhouse that manages a whole portfolio of brands. Some they own themselves, and others, like those Calvin Klein and Tommy Hilfiger deals, that they license.
And look, this problem wasn't just big, it was urgent. Their own leadership said that sales from those PVH brands started falling off way faster than they even expected. So the pressure was on, big time. They had to pivot, and they had to do it like yesterday.
So you're faced with this massive crisis. What do you do? Well, let's take a look at their response because it's a really bold new strategy for their future.
They basically did a complete 180 on their entire business model. They said, okay, no more relying so heavily on other people's brands where, you get lower margins and you have to pay out millions in royalties. The future, it's all about building up the brands they actually own. We're talking Donna Karan, Karl Lagerfeld. Why? Well, that means higher margins, total creative control, and this is a big one, they get to sell directly to their customers all over the world. And they broke this whole new strategy down into 4 key steps. Step 1, pour money back into the products and actually connect with a new generation of shoppers. Step 2, go hard on selling directly to people online, so they control that whole experience. 3, take their own brands and push them internationally, into new markets. And finally, number 4, they're not totally ditching licensing, but now it's a side dish, not the main course. It's there to support the business, not define it.
Okay, but a plan is just a plan, right? Talk is cheap. The real question is any of this actually working? And to see the proof, you just have to look at the crown jewel of their portfolio, the amazing comeback of Donna Karan.
And seriously, the results here are pretty incredible. The brand is expecting sales to grow by 40%. Website traffic, it's exploded, up about 150%. And it gets better. Not only are people spending more each time they buy, but almost 20% of their online sales are from repeat customers. Now that's how you know you're building real brand loyalty.
But that kind of momentum, that doesn't just happen by accident. So how did they pull it off? How did they create so much buzz around a classic brand?
Well, a huge, huge part of the answer is this number right here, $5.6 billion. That's how many impressions their fall 2025 marketing campaign got. They poured a ton of resources into making the brand cool and relevant again. And boy, did it pay off.
All right, so the Donna Karan story is obviously a huge win, but that's one piece of the puzzle. What about the whole company? Let's zoom out a bit and check out their latest financial report card. Is the bigger plan actually working?
And what we see is, well, it's interesting. It's a bit of a mixed bag, but in a really telling way. On the one hand, their total sales, the revenue, missed the mark. Not a huge surprise, right? They're still winding down that massive PVH deal. But on the other hand, their actual profitability, their earnings per share, that was a huge beat. They made more money than anyone expected.
Let's look at the numbers. Net sales are down compared to last year, yeah, but the key thing is their earnings per share. Even though it's down, the $1.90 they delivered was way stronger than Wall Street predicted. So what does this all mean? It means they're squeezing more profit out of every sale they make, all thanks to those higher margins from their own brands. And yeah, that drop in sales, that's the billion-dollar mountain they're still climbing. But like we just saw, the real story here isn't just about the total amount of sales. It's about the quality of those sales.
And you've got to have some serious confidence to steer the ship through a storm like this, believing that what you're building is actually better than what you lost.
And nothing captures that confidence better than this quote from G3 CEO Morris Goldfarb. He said they highlighted the fact that their business in North America is 2/3 underwear. Well, God bless them, let them produce underwear, and we're in the fashion business. I mean, wow. He's basically saying, you guys go ahead and focus on the basics. We'll gladly take over the fashion world you're leaving behind.
So this comeback is definitely happening, but they're not at the finish line yet. To wrap things up, let's look at what's next for GDI, both the hurdles still in their way and the big opportunities on the horizon.
Okay, so on the challenge side of things, they're dealing with a pretty hefty $65 million hit from tariffs. Plus, the global economy is just shaky for everyone. But on the flip side, the future looks really promising. They've got a ton of cash to buy other companies if they want, a massive runway for international growth, and get this, they just announced their first ever dividend for shareholders. That's a huge signal to investors that they are confident in the future.
And maybe this is the most telling stat of the whole story. Even after losing that enormous PVH business, their strategy of focusing on their own brands has already replaced more than 70% of those lost sales. That's not just a plan on paper, that's proof that it's actually working.
Which brings us back to the one big question at the heart of all this. Can homegrown brands truly replace a fashion titan? G3 is betting everything that the answer is a resounding yes. They're swapping the safety of a massive licensing deal for the risk and the incredible potential reward of building their very own fashion empire from the ground up. And their journey could be a sign of a much bigger shift in the entire industry, a move away from just borrowing a name and toward building your own.